All right, so Octavio sent me an email asking to analyze this position on ASML. And you had on your screenshot, you had one share of ASML at 554. Did you mean 100 shares first? Because on your screenshot that you sent me, Octavio, it was one share. You have this combined with buying a January 2023 560 put one contract at 26.55, and you're selling a December 16th 570 put and your price was 19.50. All right. Now, Octavio said the goal is to sell a 570 put to create a bulletproof transaction by selling a 570 put, buying 60 days put for protection to be kept at the sold put expiration. Can you share your opinion? Now, Octavio, I have to ask you, you meant in this case to buy 100 shares. Is that correct? Not one. In other words, you are doing a married put essentially with 100 shares and one put at the 560 strike for 26.55, and then selling this higher strike put at 570 for the 19.50. And otherwise here, of course, is a extremely leveraged position. You essentially have a calendar put spread, which is holding one extra share of stock. So my assumption is you're trying to do a married put structure with a shorter term just out to January 2023, slightly in the money or at the money where the time value is typically the highest. Yes, the 555 strike would be the house. Stock's at 593. You own these shares already. But again, I'm assuming you mean 100 shares. Now, if I do that, the maximum risk is still high. Why is the maximum risk so high? The reason why is that if you just did this married put structure, you have a maximum risk of 2055 Octavio, or 3.5%. With 100 shares of ASML that you own at $554, stocks at $593, you're buying a 560 put for 26.55. So you have a risk of 20.55 in this case, or 3.5%, excuse me. Now you're selling the 570 put December 16th. It's slightly out of the money, of course, 20 points out of the money. It's at a higher strike, and you're collecting about 19.55, which to the downside, you'd think would cancel most of that 20.55 risk. Oh, okay. I see it now. So what happens in this structure is when you're in this scenario, the put can either only cover the stock or can only cover the put. If the stock declines further down in price, you're still either seeing the significant loss on the underlying stock beyond the put strike price, or on the put that can't be covered if the put is covering the stock price itself. Now, Octavio is looking more at a calendar put spread. In your screenshot, you had added one share of ASML. You don't need to do that. You can just put it in as a custom spread such as this. Now, Octavio is saying that if ASML falls below 570, and he's put the stock at 570, minus the premium he received of 1930 now at midpoint. I know your price was 1950. Yeah, you put in 1950. 1930 is the midpoint now, Octavio. But that 570 minus the 1950, excuse me. That would be 550. In other words, just selling this 570 put for 1950, if the stock was put to you on December 16th for the 570 strike, you'd have a cost basis on the 100 shares of 550.50. You can see already that's not going to be a bulletproof trade. You're still going to have a risk of 5 or 10%. Now, I guess you're bearish on this position because it's 593, but you see the structure that if you're in right now without owning the shares and you're planning on the future purchase here, if the stock continues to move up, same thing as you saw with my income method number 1 position on the ANET trade, we're giving up profit to the upside. Because as the stock continues to move up, the max you can make for this put premium is 1930. As the stock continues to move up, this put can lose up to 26.55. So that's why we're seeing the risk that we have on this position and why it goes back. It's way up high though, 640 though, but why we see 2 break evens. We prefer not to use the calendar put structure as a means to enter into the married put position, especially on a stock that we've researched and we're bullish on, because we have a tight window to break evens. This one's a little bit wider, of course. But if we're bullish on a stock and continues to move up, we're giving up profit to the upside as we have a max set profit we can make on the put that we sold, just the premium that we collected, and we can lose the full amount on the put as the stock continues to move up in price. I understand you may have a target for ASML of 570 in the next 28 days in that case, okay? Octavio says, doesn't the put I sold go up in value as the stock goes up? No, it's not that it goes up in value. As the stock moves up, let's say it goes up to 600. And yeah, 12, 5, 17 days to let's go a little bit closer to your expiration date. Let's go a week to expiration. So your sold put is declining in price, which is working in your favor. You can't make more than this 1930. That's a cap. You can't make more than that. But as you can see, as the stock continues to move up, you're also losing value on the put option to counter the gain. Yes, you're still in a profit zone here. I put it at 600. You can see that here. You're still in the profit zone, but you're nowhere near the maximum profit. Okay, you're losing, as the stock continues to move up, you're losing value. The put that you sold is declining in value in your favor. It's not going up, but on your portfolio, Octavio, it's going up to you because it's costing you less to buy it back. But you're also losing money on the long put as well. And the more the stock increases, let's go up to 640. I know that's not your expectation either. With a week to go to expiration, you're almost even. The loss that you're seeing on the long put is up to 1700. This is almost to zero now, so you've made 1800. But as you can tell, what are we doing? We're going lower and lower and lower because you're starting to lose more on the put that you purchased. That's almost countering the maximum you can see gain in the sold put. You can't make more than 1930 on that sold put in this case. So that is the scenario. This is the profit and loss chart you're looking at. Does the profit and loss chart match your expectation for the next 20 days, 28 days, 30 days, 28 days for the underlying security of ASML? Meaning, of course, do you feel that, that's a terrible drawing, sorry, Octavio. Do you feel that this is a reasonable price range for ASML to stay in? And are these comfortable profit zones that you'd like to have for this position? That's a personal preference. That's a question I can't answer. That's up to you. But what I'm saying is that the calendar put structure we prefer not to use to get into the married put, because if I researched a position and I'm neutral to bullish on it, I'm bullish on it, and I'm looking to hold it for a longer time frame, then I'm going to enter as the married put and leave the upside open. Eventually, I might sell a call, as we saw with the net position, which will look similar to this structure. But in this case, we don't like to use the calendar put because it doesn't have the positive delta that we're looking for if we're bullish on the position. If I researched a position and I thought that, yes, this is going to be a bullish trade, I expect it to move up 3 to 6% in the next 20 to 40 days, and maybe another 4 to 5% beyond that, I don't like this capped structure. And I don't own the stock here. I have an obligation to deliver shares of stock. I have a max value that I can achieve on this position. Again, the premium I receive, I cannot make more than that. I cannot make more than the 1930 against the 2655. But as we saw, as the stock continues to move up to higher prices, the loss on the original purchase put is getting close to countering the max gain I can make on the sold put as well. Calendar put structures, neutral to bearish, neutral to, yeah, this one here is more of a neutral to bullish. It's more like a calendar call because of the strike selection that you chose. Excuse me. But again, this is not a structure we use to prefer to try to get into a married put, trying to look for a cheaper price to get into the position. I'd consider this its own strategy as a calendar put position. And again, the put is not increasing its value as the stock moves up, Octavio sold put. It's decreasing in value, which is a positive to you because it costs less to buy it back. So yes, that goes up in value in your portfolio. You'll see that on your broker, that it's gaining in value as the put is declining. The premium to buy it back is declining, but you can't make more than the 1930 on the sold put. And again, this is the profit range we're seeing for this position right now with the current implied volatilities. Does that match your target goals and your expectations for the stock going forward? If so, then you're in a good calendar put trade for what your goals are to achieve. If not, if you're looking for more upside growth, you're not going to see a lot more of that upside growth. In fact, the position is getting less and less as the stock continues to move up in price. Buying shares at this point, you buy 50 shares at the current price. Octavio asks to keep the upside open. You see less of a profit in the ranges. You know, you're looking at $400, $500, $600, $700 and this $890 in this range up to $585 and so forth. You have a small gain here. You still have a maximum risk of 103 if the stock falls. This put is covering 50 shares here. And at the same time, it can't cover the put option if the stock continues to fall down in price. Okay, so you still have a very high risk position to the downside. I'm sorry, if the stock continues to fall. Now, again, we saw some of the prices, the profit at 600. Let's just do that again. And we did that 1 week out to expiration. I think it was on the 21st, if I'm not mistaken. I'm sorry, 21 days to expiration on the 9th. So here in this case, again, where you would have had a gain of $600 roughly because the loss on the long put if the stock was trading at 600, here would be a gain of 993 because of the increase in the stock shares. We go up to that 640 price, the gain should be higher. Yeah, there we go. So even though we're almost countered here, you'd have the 2,342 gain on the stock. So now, even though this is countering itself, the 50 shares, as you'd expect, give you more of an upside potential if the stock continues to move up. But if the stock stays around the same price, let's just call it 595, see some 600, 700 decline in the put, you get the time decay you want here, $92 on the stock gain for the 50 shares you purchase at the current price. So for a gain of about $782 on the position. So just as you'd expect, yes, putting that extra capital in would be able to benefit and leave part of the upside open for further gains if the stock really took off and kept going, Octavio. But again, now that we still keep the risk at a high level, because yes, 50 shares here would be covered by this put, or the 570 strike put would be covered by the 560 put minus the difference in the strike prices, those 10 points, and the 50 shares would have an open risk to the downside, depending on how you want to look at what put is covering, which this long put, excuse me, is it covering the short put completely? Is it covering the 50 shares and half the decline in the short put? So on and so forth, still taking on a high risk on the position as well.